Hi guys, this is Simon with toughtrader.com and Trade and Perform Coaching. So last week was a crazy week. I mean, just nutty, right? And I know a lot of people got run over. A lot of people made a lot of money, right? We had a very good week in the room, and it's been a long time since we've had this kind of two-sided massive volatility. So I wanted to go over some of the basic rules of trading. Now understand, I'm personally a leverage trader, right? I'm intraday basis only, and I'm looking for key locations, and I'm willing to go short and long at any time. But I have some basic rules to help me find my areas and avoid making really big errors in decision-making process. And so I want to go through those rules really quick, and I'm just going to focus on ES today. I'm not going to use the profile charts that I normally use. I'm just going to get down to helping control emotion and decision-making and stop-loss management. And we're going to try to keep this as short as possible. So let's say we'll shoot for 10 to 15 minutes, and then I'm going to get out of here and enjoy my afternoon. So let's get started with the day. Number one, if you'll look, one of the most difficult things that people have so I'll give you a great example. People have been talking about just basic support resistance areas, where you would normally draw those lines, and I have them on my chart. And a lot of people were looking at 2580. Now, the reason why I mentioned this is specifically FT71 mentioned 2580 as an area where he was looking for a buy response. This is not a slam on FT71 in any way, shape, or form. I think the guy's fantastic. He's helped a lot of people. Zero criticism of him, right? But he said 2580, we should try to build some support around 2580, right? And then someone would go and say, hey, I'm going to take 2580 and I'm going to make it my trade, right? I'm going to make that my trade. I'm going to take it there. Well, there was a couple of problems. If you took 2580, right? So what we're talking about, the area we're talking about, so everyone's clear, is this 2580 right here. It was a retest, I believe, of the prior day's afternoon's low. It was a critical area. There was some support from the profile. There's lots of reasons to want to be long there. And it was a fat rotation, right? You're talking, the high was essentially 2620. It was a 40-point rotation down. And it made sense to try to find a response. And eventually you'll see we backside tested that same area twice and eventually pushed really hard out of it. So if you just bought 2580, one of the problems people are having is if you just simply left your order at 2580, you got run down all the way to 2565. So in terms of dollars per contract on the S&P futures, that's a, let's see, 10 is 500. You add another 5, that's 250. A $750 per contract loss in here, right? So how would have you known, A, that it was going to break, and B, how would have you handled trading that location that made more sense? And I'm going to show you here. So first of all, the first thing you had to realize was that you may not have been able to trade that trade if you could not handle the appropriate loss. But secondly, when the market's in a free fall like this, I hammer this in my room over and over. I think it kept every one of our team members in safe condition. When you get one big red bar, so I like to break this down and make it as simple as possible. One big red bar after another big red bar after another big red bar, right? 3 in a row. When you get those, and I do not want to step in front of this, right? And why is the reason why I don't want to step in front of it? Because sometimes it may end up looking like this, right? And other times it may end up looking like this. And when the range and the volatility is so wide, and so many people have gotten comfortable with, hey, I buy every 10 points down or every 15 points down in the S&P 500, and I just make money, those days are gone. Not only that, but the other part of the mentality of the last 5 years, and particularly the last 2 years, is that you're like, hey, when you get this bar, you're thinking retest the highs, right? You're not thinking it's going to come back and set a new low. The market is telling you, if I don't stop throwing my mouse, the market's telling you the rules of the game have changed just a little bit, right? So let's go back to how we would handle this. So the first thing I need to see, so let's start from the morning and we're going to work our way into this. The first thing I need to see is before I want to get long, I'm going to look, what was the first 5-minute opening range, the high and the low. I want to either be below or above and get that area backside tested for a trade. I want to have some way or method of going when I'm inside here. So for example, I understand that people, if you took the long when you came into the last bar of the day here for whatever reason, you knew you had to get a close above this level in order to push. The fact that we pushed above and were unable to close should have been your first warning. But really what would have been your bigger warning is what your bar should have looked like in here. So what we're talking about is the expectation. I always push for this perfect look in the market. I would have wanted this second bar to have closed back within the first 5-minute bar to push out. The fact that we didn't showed you that we were a bit heavy with sellers to start the day, but we haven't filled the gap yet. Everything looks all right. Well, then we push up and we fail to close above. Now, here's where your next problem comes in. Remember, your low to start the day is this first 5-minute bar. And we see how we backside tested once, backside tested again. On the third time, we backside test and we close below. First sign, that's usually the second test is the one where you're really in trouble. I constantly talk about first trap, second trap. That was the first trap, and it said we were really in trouble, right? To guys who've gotten used to, and what I'm trying to point out is holes again. The number one thing you did not get here, and I want to show you this, you wanted to close above your best last seller, and you want to close above your first 5-minute bar, or you want to be far away from that 5-minute bar. Either way, one of the two, so that you're not getting run over, right? But even within that process, right? And I'm going to show you this multiple times through the day. Let's say you did think it was going to go up, and you go, okay, right here, Simon, on this bar, right inside this bar, I've now closed above my best last seller. That was this bar right here, right? Closed above. That occurred right here. And if I come right back over here, and I tag in just like this, right? I now have an entry and a stop almost automatically, whether I want to use this stop or this stop. Now, I want to go back on this point for just a second because this is a really, really important point in this process. Now, this is a very basic rudimentary way of thinking of the market. You go, hey, I got above my last seller. I can start searching for longs. But this is where a lot of people end up losing money on their trade. You come in and you backside test this. You're backside testing your last best seller, but what's your stop? 2608 all the way down to 2594. And this is the mistake I see happening over and over and over again. If you want to get long there and your stop is the swing low, which is the appropriate stop for that backside test, right? From 2608 to 2594 is 10, let's just call it 15 points, right? From 2608 to 2594, it's 13 points, excuse me. Okay, so from 13 points, if you go, look, all I can afford is a 5-point stop on that trade, $250 a contract. What I see a lot of people doing in that environment is they're trying to take it right at the top of the bar and use a 5-point stop, and all it does is get them stopped out. The way you should rework that trade, I'm going to erase this, but the way you should rework that trade, let me remove the drawing objects, is you should go, this is my stop. I want to stop 1 point behind there, 2592. And now my entry becomes from 2592 plus 5 points, 2597, right here, right? Why is that important? Because now, even though this trade ended up stopping, and that's not what I'm trying to avoid here, we traded above my best last seller. This is the stop I can afford on the trade. You may or may not have gotten filled at 25.97. I'm not going to go look one way or the other. But if you did get stopped, you now gave the chance to hold that swing low and get your push out to the upside. And it's manageable instead of entering in, out, in, out, in, out, trying to make a trade work that's about to fail. Now, I'm going to show you the exact same point over here. This trade over here gets you above your last seller, right? Here's your backside test. I want to show you this. This is your backside test right here of your last seller. See how that worked? What was the stop that's required to make that trade work? I want to emphasize this really, really clearly. And this is going to come into play later in the day. Your stop on that swing low is all the way at 25.65.92. But what's playing against this trade here? So I'm not explaining this nearly as clearly as I wanted to, but this will make sense in just a second, right? So first of all, what you'll see is when we're looking at this trade is that we are already making lower lows and lower highs. This is my last swing up. See how we pushed and then rolled to the downside? I know that I need to get above this point if I do get long. Secondly, my entry method, this is where there's a lot of conflicts that come in. My entry method called that I get the backside test of this location. And now my conflict is my proper stop on this trade. I can take this trade, right? But if I did the same little trick right here where I took the backside test over here, I ended up losing money on this trade, and I'll end up losing money on this trade, by the way, just so you know, with the way I would prefer to enter the trade, but it'll be in controlled, measured entries and exits, right? So I want to show you this. We roll down, we backside test this, and it does give you the roll back to the upside. However, your stop had to be all the way down at 25.65, which means from 25.65, if you entered at the top of this bar right here at 25.84, you're talking about 20 points. Most people can't afford it. And here's the response I get from people that I coach. They respond and say, hey, but the trade worked. And I go, hey, I agree. But what I see most poor traders doing is they enter here, and sometimes this works, but what they do here is they get the idea that, hey, we've gotten above my best last seller, it has to work. And they keep trying to enter over and over and over and over on the way down. Now, I'm going to point something else out. This is an engulfing bar right here versus this bar was not engulfing. So it gave you more power, but the one thing you do not want to see off of an engulf, and it actually wasn't quite engulfing. It closed above the bar, but it didn't trade below. Nonetheless, it's clearly the best up bar that we had all day long, right? And what people don't want to see on that specific bar, I want you to look at, see how that 50-60 right there? See how you didn't want it to close behind that 50-60, and you can see they specifically defended the 50-60 of that bar, right? So why was that important? It's important because what I'm more concerned about is, instead of finding the winning trade or how I make money, I want to find the trade that'll let me get paid without running interference. So let me show you how this should have worked out for the long side trade. The problem that we have here is, see how we pushed up? We did backside test, right? We backside tested my best last seller, and we pushed up. This bar then became my last best buyer up here. See that? So on this bar here, when I closed underneath my last best buyer, yes, we're now above my last best seller, but now we're below my last best buyer. That creates a conflict in the trade, and I'll show you how that played out upstairs. What you would have wanted was to get this trade to backside test right here and never get back below your best last buyer, which occurred on this bar, because once we close underneath, which occurred right here, this guy became your resistance all the way through, which is why we rolled down. You end up with the same conflict right here. When you push down, you get your last best seller, you close above them, you have an engulfing bar, but what you wanted to happen is you wanted on your next best buyer, you never wanted to get underneath this guy, right? So even if that left you without a trade, you are right, because what ends up happening is you'll see they defended the 50-60 of that bar right when we closed behind. That's what gave up the ghost. Again, remember, what's the context? Lower lows, lower highs. So watch when we finally get into the low. I want to show you this, where this pays huge dividends. See this right here where we're coming in? This becomes your last best seller, right? Then this guy finally becomes your last best seller. Even if we use this bar right here, we said this becomes your last best seller. Notice there's no one engulfing bar like you had back over here. But if you'll go back to that process, right, of what's my stop going to be, once I get above this guy, I'm hoping for a backside test right into here. But now I have a manageable entry exit stop relative to the range. Notice that the top of this bar right here was 25.8475. The bottom of this bar became 25.38. Now, that's 10 points, which in this market where you're talking about 20 and 30 points worth of stop earlier, this now becomes much more manageable. So if you're day trading ES, you have to slow your process down further, right? You have to get a meaningful time frame that you can manage under. If you're not using delta, if you're not using tick divergence, things like this. But this is why the market's so hard here, right? But if you'll notice, if you did the exact same measurement and you go, okay, now I can test back into this seller and afford my swing low, you end up with a manageable trade, a manageable stop, right? So I want to show you this. See how you ended up with a manageable stop right here. You're trading, I would probably venture to say this was your best last seller, not this guy, but either way, however you're looking at it, if you traded into 25.49, you still got to roll all the way back up to 25.53. Why is that important? Because that meant the trade was scalable and you could move your stops up for the swing, or you could scale enough if you took 25.49 to help offset the loss down at the low. Either way, what you were hoping for here is, once we tested back in, was for a launch out of this area. Now, what you will notice in addition is that we finally see how we pushed back up, and what became the problem here? We got back underneath when we pushed back in for this long here. What you wanted, right? What you wanted was for us to test this area right here and never get underneath this bar right here. This is tricky, right? But if you look, when we finally pushed underneath in order to get your long, which occurred on this bar right here, we also simultaneously closed underneath this bar, which created resistance on the upside. That was the problem. So it didn't set up perfectly. Finally, the push to the long. And if you remember, 25.31 is the 200-day moving average. 25.35 is the 200-day moving average, right? And so then if you'll finally look, when you finally get above your best last seller right here, which occurs right on this bar, if you'll see we closed, you know what? I think it depends on which time platform you're on. On my Sierra charts, this is one tick above. It was. There you go. So see how you finally closed right here, just above your best last seller? Notice that's the first time that that's happened on the very following bar, where you closed below, right? And you finally, well, I guess it happened right here, and you ended up with the same backside test, right? You closed just above, immediate backside test. Now, again, what's the problem with this bar? It was huge. Your entry is 25.41 against 25.30. I guess it's still 10 points. It's not a horrible stop, right, in this environment. But now look at your payday as we launch off and out to the stratosphere from there. And then you start that process all over again. See how we start rolling down, and the sell bars are getting smaller and smaller here. So I want to show you something here. Why is this not letting me? There we go. So notice that we get this huge lift, right? Notice that this becomes my best last seller, but no big rotation down. Then this becomes my best last seller. What I'm trying to show you here is that instead of buying into this free fall where you don't know how far this is going down, finding your best last seller. I guess I've gone a very long way to explain this, and so I apologize because I really get into the nitty-gritty of the trade, right? What I'm trying to point out is for your best last seller, both for your shorts and your longs, instead of just taking the trade while it's in an absolute free fall, what you're looking for is to get above that last seller and then trade against him, right, as they're pushing back against. But what you're trying to do if you're a small account, or even if you're a large account trading a lot of leverage, right, is you're going, look, my stop has to be the swing low, right? So you're kind of caught in a challenge. If you're a 1 or 2 contract trader, right, very few people, right, very few people want to take a 25.42 for 25.29 stop, right? But then there's the other side of that. If you take the top of this trade right here, let's say you go 25.42 and you put a 5-point stop on the trade, you have very high odds of just getting tagged out for a 5-point stop and still watching the trade work. So what do you do in that situation? What a disciplined trader does in that situation is they do one of two things. They either say, I'm going to find a way to find location within that bar, so I'm going to go to a smaller time frame and looking specifically at the last sell bar and try to find a location against where it should work in a pattern that works, which can be done, right? Mostly I would say by using delta charts. Or plan 2, wait till the size of the rotation comes in a bit. And FT71 has said this. Anthony Crudell has said this. Almost every good trader I know out there that's trading out there has said the same thing. If you can't afford the proper stop on the trade, there's nothing wrong with waiting till this volatility drops to return to your trading methodology. But I assure you, if you adopt this methodology of risk reward of what you're looking for a trade, just like you got below your last best buyer over here, even if you, for some reason, we're still looking for a short over here, notice the relationship. Last best buyer gets backside tested before it rolls down. Last best seller gets backside tested. It then becomes an area of, hey, and what does that save you from? Gosh, I should have started this from the beginning. I guess it's Sunday and I'm slow. What that methodology saves you from is this, where you're just getting absolutely ripped to the downside. You know, right, that you've already tested the top of that last best seller and they've tried to lift off of him and they couldn't, right? You know over here, when we push down and we test into this last best seller and they push up and they fail behind them, you now have overhead resistance. So now, even if you miss the low, right, I see people all day long wanting to go, hey, I want to catch the low. I want to catch the one. Who gives a shit about the 100-point trade? If you're a swing trader, that's great. But look at all the carnage that took place before we got that 100-point swing versus the trader who goes, all I'm going to do all day long. So let's say you had an unlimited stop, because the primary principle is what matters, right? So all I'm going to do is say, hey, if I can't get above my last best seller, I don't want to go long, right? So look at how the principle by itself worked. Last seller, you closed above your last seller, you backside tested, it gave you a little wiggle up, then it failed, right? Never mind the first 5-minute bar, which was more important, but we'll keep going with it, right? You then started to roll to the downside. Notice you cannot get a close above your last seller in this whole rotation down till right here. Notice that we come right back and test your last seller, and it gives a rotation up. You do okay in this environment, but more importantly, right, it lets you know, hey, I was able to close above my last best seller. Some of the momentum to the downside is waned, right? Your stops should get more controllable in that process, right? If you'll notice, as we keep rolling down versus just simply catching it as it's free falling on you, which can be a horrible experience. And one of the key notes of this is when it gets really ugly, like it did through here, notice that we can't close above our last best 5-minute seller, right? And notice that when we finally do, when we test back into them, these two guys right in here, you at least finally get a counter rotation that you can trade off of. And so then I'm always going to get this constant feedback. But Simon, I missed the low. So what? If you're a leveraged day trader, you do not care about the low. You want to catch the meat in the middle of the trade. And look how that ended up working out for you. You came up, you roll down, you finally close above this last seller. Now you might have gotten a stop on this trade. I don't have any idea of how volatile this, for all we know, this thing rose 5 points before it smashed you. We don't know. But what we do know is we close above the body of the bar, right? Wasn't much of a rotation back. I don't know if you had any support here, but you came back and tested them. It stopped you. No big deal, because guess what? You got another chance right here. Came right back over here, backside tested your last best seller, and it took off. And let's say you got bearish up here. Let's flip the scenario the other way, right? Hey, I'm looking for a way to short. Starting on this rip, this is a total head fake. Great. This is a perfect example of get me underneath my last best buyer and explain to me exactly where that happened so I could look for location. Well, that happened right here on this bar. I can now start looking for location and attest back into this bar to look for my short location if that's what I want, right? If that's what my chart tells me. Just like when I'm ripping up through here, right? And you go, well, I'm looking for a short over here. We've gone up 100 points. And I'll say, great, get underneath your last best buyer. Well, that doesn't account or does not happen until you got underneath this bar. And if you'll notice, the backside test up and towards that bar actually gave you rejection. We didn't quite reach it, but that's where it gave you the rejection. So to close my statement down, okay, and make it really clear, because I was a little, obviously when I'm not trading, I'm not as sharp as I normally am. So this is what I wanted to communicate. First of all, the stops are going to be big in ES right now. There's nothing you can do about it, right? But if you try to trade this, right, and you're not an expert, and what I mean by an expert is you better be looking at this stuff like this. This is NQ. This is a 5-range bar. This is what I'm trading right now for scalping, because my stops can be contained within 5 and 10 points on NQ when we're experiencing 100-point bars. So this is what I mean by I would consider myself an expert in day trading. And this is what I mean by, excuse me, this is off my other computer. And this is what I mean by you better become an expert. But I assure you, with a little more sophistication, I'm applying the exact same principles to finding my longs off of lows and shorts off of a very small time frame. Let me see if I can stretch this. This was the exact same area of the low on Friday that I was looking to get long. Excuse me, that wasn't. It's a lot of data. There's the low back here. There we are. I was looking for the same, using the same principles on a very small time frame to look for longs and shorts through the course of the day, as I'm suggesting on a higher time frame. What have I done? I've had to go and smash that process down to a very small bar so that I can handle the leverage that I trade, because obviously no one can trade in this range. So what's your option number 2 if you can't afford the stop? You have 2 possible paths you can follow down. You can either use options to minimize your risk in the trade, but that gets tricky because of the time melt and the premium due to the volatility, right? Or you can go trade the spiders, right, SPY, where you're trading in a cash market that has a lot less leverage, and you can adjust the amount of risk exposure you have to that so that you can cut your stops down or make your stops affordable within this process. And they actually give you access to get a rip to the upside, like you're being able to sustain in this area. Or number three, and I'm going to show you this really quick, format, symbol. This is, we're going to go back to 2009 for a second. Take a second to draw the data. Okay, we were coming out of, and I want to pull this down to a 15-minute chart really quick, or a 60-minute chart so you can see what we were looking at. If you pull this in, you'll see we were quite volatile because the market, format, symbol, oh, it is 3 years back, just hasn't downloaded the data yet. There we go. There we go. You'll see we're quite volatile. The market had just crashed. We had a lot of whips back and forth. See how this area right here, this is October of 2008, where it was quite untradeable. The ranges got really, really wide, and it was hard to control your stops. So I want to show you something. If you got blown out in this area because you were trying to trade a small account or a ton of leverage when the range was so wide, if you just waited, so that's late November, right? If you just waited till December, right in this area, right? So I want to show you. First, we're going to go. So we're going to go look at that on a higher, on a low, excuse me, tighter range. So I want to show you this in this range right here. Oops. In this range right here, the rotations through here were enormous. You're talking about a roll intraday. We went from 749 all the way down to 682, and if you'll give the context of the time, that was a massive roll. Intraday rolls got just really huge. We went from 715 to 602, 100-point ES ranges. So this is not unprecedented. Just like we had a 100-point rally, we were having massive rallies at this time. And if you'll look, individual bars were also huge, 639 to 614, over 20-point bars, right? Now, go look just a little bit down the road, and all of a sudden, everything settles down. See how small the bars are? Where the range is still tradable. Hell yeah. Look what happens. See if I can move this around. This is one of the biggest bars I can find, right? So let's go measure and see what size that is. The biggest 5-minute bar here, we'll use this one. That's 650 to 670. Still not a 40-point bar, and that's the biggest bar you're finding in here. The majority of them are getting cut down in size. Look at that, 713 to 720. 7 points in a 5-minute bar is very tradable and very doable, right? So that's coming. If you'll notice, it wasn't a big transition. All of a sudden, it just switched, right? See that? Massive range, tradable range, just like that. And the ranges, we still had trend day down. And if you'll notice, even way back, going back to 2009, right? If you installed that exact same premise, hey, I don't get long unless I can get above my last best seller, saves you over here. See that? And that's 60 minutes. Let's go to a 5-minute, excuse me. Apologize. Same area, right? So you'll see when we're going into these nosedives over here. Let's open it up. So see this right here where we go into this nosedive? Notice we can't get above our last best seller, which is pretty damn easy to identify. Again, we can't get above our last best seller. Then you'll finally notice, look down there, right in here. See how we finally get above our last best seller? How big is the points on that? Let's go find out. Top of that bar is 634. Bottom of that bar is 629, right? 5 points of range, backside test, maximum extension, 638. Very manageable. Same thing right in here. Here's your best last seller. There's your backside test. You're from 627 to 629. You're ripping 1 and 2 points out of the market, even in a trend day down environment, right? You want to short? No problem. Look right over there to your right. See how you get over? You push up in the morning, right? This is the first place you close underneath your last best buyer. You backside test into them. You have entry, exit, stop, entry, stop, target down below, right? You get above your last best buyer. Someone's going to say, well, Simon, I got above and you never got a backside test. Well, you're absolutely correct. Sometimes it'll run away from you. But if you're looking for location, right? You don't want to trade the mid of this range. We just filled the gap and popped, right? You get up here, they consolidate. You get underneath your last best buyer right here. This is your last best buyer. You backside test and you get the roll to the downside, right? You get above your last best seller. You backside test. You get the pop. It's not foolproof. Obviously, I'm not the first genius to have figured this trade out, right? But this saves you when you're just hard rolling to the downside, when you're melting to the downside. The concept and the idea then should back you up to going, okay, am I getting above my last best seller at a key support level or at a key resistance level, right? Are we on a stretch, right? Do I have tick divergence? Those are the questions you should be asking through the course of the day. So as everyone can tell, or as you may or may not be able to tell, I'm not that eloquent a speaker, and actually, it turns out I'm a pretty good teacher of how to trade futures. I've had enormous positive feedback from the guys that I've coached one-on-one and within the room, right? But what I'm not is eloquent in being succinct, and that's the disadvantage of being dyslexic. My mind doesn't operate on a linear plane sometimes. It just sees the full puzzle, and it's hard for me to break it down to small pieces. But that's one of the big pieces I'm looking for. So the questions I'm asking go in order. First of all, am I above or below my last best seller? Because I want someone to be trapped when I take the trade. Next question is, where am I in the larger picture? Am I above prior day's high, below prior day's high? Am I above the value area, behind the value area? What's the stretch? Do I have tick divergence? And would I normally be in an area where I'm looking for buyers? So let's say we're down here and I go, hey, I'm looking for buyers in here. Do I get the pattern that I can find to find the pop? If I don't, no big deal. Same thing in here. Hey, we're on a big stretch, right? In here. And I go, I want to get above my last best seller. Well, notice I can't do it here, right? Can't get above them. And sometimes I just have to deal with the disappointment of missing this rip. But I'll tell you right now, the disappointment of missing this rip can be simply replaced by going the majority of the time, I do get that test back in. And I'll show you right here. See this right here? I close above them, a backside test, and I get paid. And I only need one or two of these a day, right? Just like I get below my last best buyer here, backside test, I get paid. I only need one or two of those a day. If I end up missing this, and if I sacrifice this trade in exchange for not getting ripped on this trade or this trade, I'll gladly do it because I know I'll get enough of these trades where I backside test into my last best buyer, my last best seller. I know I'll get enough of those trades where I get paid on them that I can miss this. But to me, the value from protecting my equity in my account and missing a burn down like this, or missing getting short, if I decide for some reason, right, that the market's short, let's say a very common trade, someone takes the 50-60 and goes, hey, I'm going to short the 50-60 back up into it. Everyone has seen that trade, right? And they get eviscerated on the way up and they lose a lot of money. Well, if all of that person did who shorted in here said, let me get underneath my last best buyer, and he goes, oh, well, there we go. I'm underneath. Now I'm underneath. Where's his location to short? His location is right up against this bar right here. So then he just has to simply make a decision. Am I going to short going into the close or not, right? Hopefully not. But if he did, that's fine. At least he had location, right? Versus I shorted here and got eviscerated on the way back up, right? So that's my 2 cents. I hope that helped out, guys. If you liked the video, give me a big thumbs up, a like button, if you would, please. If you'd like to join us in the room, you can email me at tradenperform@gmail.com. And I would be more than happy to send you a 5-day pass. So anyways, trade well. This is hard. Protect your capital is all I can say. The insane volatility will end for more tradable volatility, and both of them are tradable, but no one in my room blew up this week, and I think that's really, really important. Anyways, I forgot one last piece before I go. Just got to flash this up there really quick. I should have put it in at the beginning. Past performance is not indicative of future results, right? This is for educational purposes only. And I'm sharing my trade plan with you. Please have a risk management plan in place. Don't blow yourself up. It's not glorious, cool, or anything else, and it's totally unnecessary from everything that I can tell. So anyways, that's my 2 cents. And Wow, that was not very helpful. Look at that. Let's magnify that. See if that will come into play. Wow, that wasn't any good either. We'll just go and I need that disclaimer, but I really don't have it anywhere. Let's see, legal. There we go. So if you want to take a moment to read that, that'll be fine. And I hope everyone has a wonderful weekend. Trade safe this week, guys. It's going to be volatile probably all week long, and that's a good thing. Look for the beginning of failed range extensions up and down. That you should see that trade set up quite a bit, and it should pay very, very nicely going forward. Okay, guys, have a great day. Talk to y'all later. Thank you for joining.